Welcome back. You're watching Business Lunch. Now, we've been decoding the impact of the goods and services tax on various sectors and industries, and now let's put the spotlight on the insurance space. The GST Council has suggested an 18% tax rate for the financial services sector, which would mean a direct impact on the premium paid by policyholders. Sandeep Batra, the Executive Director of ICICI Prudential Life Insurance Company, now joins in from the sidelines of the Kotak Institutional Equities BFSI Forum. Hi, Mr. Batra. Good afternoon. Thanks very much for your time this afternoon. I want to begin by talking about GST itself. We understand that the current tax rate on insurance premium is 15%, which could go up to 18%. Any early calculations you might have done on what this might mean in terms of, higher premium to be paid and what it might be for FY18 for your company?
Well, GST comes in effect from 1st of July, as you are aware, and I think you've rightly pointed out the rates have increased from 15 to 18%. So consequently, there would be an increase of about 3% for all policyholders. So I guess that's a cost that we will have to live with, given that GST otherwise is largely positive from an economy point of view. It will aid larger financialization of savings as well, and movement from unorganized to organized sector. Given the overall positive part of GST, I think we just have to live with another 3% at this point of time.
Hi Sandeep, this is Abhishek here. What kind of growth outlook do you have for FY18? And also, how do you see your product, ULIP versus non-ULIP in your portfolio?
Oh, I think let's not talk of ULIP versus not ULIP. I think it's more about savings products and protection products. If you see the entire saving basket, unit linked is there, there's participating and non-par. As a company, we try to sell customer-centric products and largely are agnostic to the products that the customer buys. The other segment that we are focused on is protection, and which we believe is a pretty large larger opportunity given the extent of under-penetration that is there on the protection space. On the saving side, whether it's unit linked, par or non-par, we are competing in the larger financial savings space. Given the sort of movement towards financialization of savings, as you're aware, in FY17, out of the total savings in the country, 45% went into financial savings. We do expect this movement to continue. We do expect now, and if I put these numbers in context, the total amount of savings which happened in FY17 was about 12.5 lakh crores, which is about 18%, which is part of the financial savings. If we assume that the nominal GDP of the country will continue to grow at about 12%, and the financial savings pie moves in from, say, about 45% to the early 50s, we could clearly see the financial savings pie double from here. It could be closer to about 25 lakh crores in about 5 years' time.
But,
if this happens, I think the beneficiaries are there, everybody in the financial savings space. I mean,
I take your point, Mr. Batra. A lot of the insurance companies...
And we see that as a big opportunity.
Right. I take your points. A lot of the insurance companies, the top-line growth has been quite steady. Profits, though, have been subdued for the, many companies. What's the reason for that?
No, that's a very good point. I think you have to see how the insurance accounting works. In an insurance contract, the way the Indian accounting and, that's true for actually globally, when you sell a new policies, you are making a loss in the first year. Insurance, as you are aware, is a very long-term nature of contract. Right. And it's only in the second, third, fourth year that you start making money. So PAT is not necessarily the best of metrics for an insurance company to be looked at. And a better metrics is what we call as the value of new business and the embedded value. We have been putting this out in the public domain for 2 years in a row with fairly detailed, and it's also independently reviewed by an actuary. And we will see that number, that for us has grown by about 60% last year. So, that reflects the present value of the profits that we hope to make on the products that we have sold during the year. So I think that is a better metrics rather than just looking at PAT, especially in a fast-growing environment as we are in. PAT becomes relevant when you start growing in your, low teens, because that's when you don't get enough strain.
You mentioned about the protection plan, you know, that kind of aiding your loan growth. And even if I see the change in mix, it has been tilting more towards the non-ULIP or the protection side. And that is a high margin business. And as we can see in your reports published already, you know, your margins have been improving. So how do you see margins going ahead?
So our margins has been a function of, I mean, let's look at the absolute numbers. Margins is a function of a top line growth. It's a function of better persistency, efficient cost management, and some amount of better protection in the overall mix. But I do not want to classify things as ULIP and non-ULIPs. As I mentioned, ULIP is just another savings kind of a product which has where the cover is 10 times premium. That is true for a participating product. It's true for a non-par product. They are all savings-oriented products. I talked about this, the savings opportunity, which is largely there in the financial savings space. Then there is a protection opportunity where the premiums are low cost. It's probably the first insurance product that any consumer needs to have. And we see these opportunities as two distinct opportunities, and we continue to remain focused on both of them. They both have a role in the life of a consumer.
One last question, sir. What changes would you need from the regulatory point of view? And also the fact that IDA has opened up more banking tie-ups in the insurance sector, but we have not seen any movement on that front from insurance companies. Do we see that movement coming up from ICICI Pru going ahead? So two questions: regulatory changes that you would like, and any bank tie-ups coming up.
No, I think the regulator has always been very proactive and customer-centric. I think we are very happy with the current pace of regulations, the way they are coming out. In terms of open tie-ups, we are always, we were always open to tying up with more banks as and when opportunities do come up.
And sir, just to wrap up where we started, I want to ask you about the compliance costs increasing post GST. You know, individual state registrations under GST will now increase the manpower cost and also the overall compliance cost. So what would be the increase in addition to that additional 3% that you spoke about?
There will be a one-time cost because you have to the systems have to be made to be GST compliant. I don't think so that's going to be such a significant amount in the overall things. I think we have to look at GST as an overall space of what it does to the economy as a whole. Clearly, it's a big reform. It makes the whole of India come into one tax rate. As part of that, there would be one-time setup changes that we will do, but I think that's part of doing business.
All right, sir. Good to hear that note of optimism. Mr. Batra, thanks very much for your time this afternoon, sir. Enjoy the rest of your conference.